Hello, everybody. This is John Blank. It is Monday, August the 15th, 2022, and I'm setting off on a new Zacks professional services discussion today. Before I do that, I want to give the usual disclosures. You can read all this boilerplate on your own later on, but the basic point is this is the views of John Blank, PhD, and they are not necessarily the views of Zacks Investment Research. So let's get right into it today. I want to talk about the late summer 2022 look into macro expansion variables. We're going to take a deep dive today. Obviously, this is the big issue right now, whether we're in a recession or whether we'll have a recession. I want to get through more detail that you can get on Zacks Professional Services about the macroeconomy, more indices, more sub-indices, more macro expansion variables that are available to you to look into. The more we get into this subject, the better we'll understand it. So part one will be anatomy lessons in a COVID shutdown, high price cycle. We'll get into those internal sub-indices and show you how the prices played out inside those sub-indices. All of us know inflation emerges out of shutdowns now, or at least we should. And we also need to now understand how they play out on the back end. As the prices compress, obviously, we have to look at the other sub-indices to see if the recession happens when the prices compress. Who knows? We got to get into this. Maybe there is a way to know. Part two, status of the U.S. consumer and worker. We got to look into overall demand metrics. Those are also going to determine whether we're not going to have a recession. And part three, the variability of all this. Typically in a recession, this factor called total factor productivity gyrates a lot. And it's the volatility in this that we also have to factor in. So we'll get into briefly showing how cycles drive volatility and productivity gains. Those are terms that economists use. They actually may or may not create long-term productivity. Okay, so part one, anatomy lessons in a COVID shutdown high price cycle. Like I said, we need to understand we have left a COVID shutdown. There actually was data from the 1918 Spanish flu pandemic, and there was a study by the National Bureau of Economic Research. You can get it. It was done in May 2020, and you can learn that it is known that prices will rise after a shutdown. Of course they do. When you cut supply down, you're going to have higher prices. The first thing I want to debunk right away is that we shouldn't have expected higher prices. We should have. The NBR knew about it. I don't know why this was not anticipated in advance. All right, movement in various business activity series for the ISM, Institute for Supply Management, based in Phoenix, Arizona. It's a long, very respected, long-standing organization. I only have the data for the last 14 years, running back to 2008 here, and then running all the way to 2022. So first of all, I want to point out on the right, the left-hand, my left-hand side, your left-hand side, right here where I'm circling, that is the manufacturing ISM that comes out the first day of the month. And over here is the non-manufacturing ISM, which comes out on the third day of each month. These are monthly series. This is the manufacturing one that's more important. It comes out the first day of the month. The ISM non-manufacturing or services comes out on the third day. It's less volatile. This is more volatile. People care about this more as a forward-looking indicator than this one. Even though this is more of the economy, this is more interesting as a forward-looking indicator. You should also know that on the fifth day of the month, there's a hospital PMI. Nobody ever looks into this who's not into the hospital PMI, but there's actually a third release. So it's a 135, first the manufacturing, then the non-manufacturing, and finally the hospitals. Now, there's 11 variables they look at. The top one is a composite variable, the ISM composite. Now, this is where you have to understand that only the top 5 of the 10 sub-indices that ISM collects are contained in the composite. Those will be new orders, production, employment, supplier deliveries, and inventories. I wrote all of those up here. These are the 5 of the 10 sub-indices that make up the composite. So do not understand the composite to contain 10 sub-indices. They collect 10, but only 5 new orders, production, employment, supplier deliveries, and inventories are contained in the composite. So today I'll also show you the trade and the customer inventory sentiment on the manufacturing side and what's called inventory sentiment on the non-manufacturing side. These are all series, including The prices, which is also, as you can note with these five, prices, ISM prices are not contained in the composite. The thing I want to point out here is inventories here is not the prices of inventories. It is the level of inventories, inventory levels. So there's a thing called the monthly metric. It's a monthly metric series on the ISM website. You should definitely consult it for understanding the internals of this. This is all very, very important for your understanding. When we get into the deeper dive, you actually have to understand why ISM collects these. They actually do it to help purchasing managers anticipate change best. Those are the forward-looking people looking at for forward-looking indicators. So the way to think about the ISM series is they've got 5 that they'll run into a composite. They've long time collected. 5 more they've learned over time they like to add, and they'll collect them separately. For example, customer inventories, looking down to talk about what you think your customers are going to do. And we're going to see that collected in here over on the blue line. This is this line. Customer inventories is actually not in the composite indices, but you can see it's critical for understanding what's happened during the shutdown period. This is people who are purchasing managers estimating their customers' inventory, so downstream. So you can see that generally speaking, this never gets above 50. They always see some unfilled demand from their customers. This is typically the case. You can see it's fairly stable below 50. It did dip down. There was some strong here. You can see there was actually a fairly strong economy from the manufacturing perspective for a few years, from 2016 to 2020, and then it plummeted, right? This is now their customers' inventories. Their customers' inventories are very low. So this is not their inventories. We get into their inventories. Notice down here, manufacturing inventories. As you can see, those have actually plummeted early, and then they're now quite high. So the manufacturers themselves are building inventories to satisfy this unsatisfied demand. Now, this gets into the final thing we need to talk about, which is the price index. And again, I told you manufacturing prices in the ISM are what they're paying for their manufacturing prices, or charging, I suppose, but this is not in the composite. And as you can see, the manufacturing production index ramped up right out of the shutdown first. The services ramped up a little later. We know that's because the vaccination took place here. They let the manufacturers open up a little earlier, and then the prices for those manufacturing goods spiked first, and their spiking ended somewhere in the middle of 2021, and now we look at the services may have rolled over just quite recently. Fascinating stuff, but I want to point out here that it's actually in the 2008 period, you can see prices spiking up and then plummeting during the true recession. And you can see here, they just spiked up and stayed up through the shutdown period. So this is actually quite different. You can see the stability of these prices and the length of time. This was all imposed on the economy here and here. Here you can see it was more the chaos and the crisis. This is something that was more endured. This was more unexpected. So, but generally you can see that if we look over a lot of time on these prices, when they do spike, they will come down. And sometimes they can come down quite some time. So this is what we're looking at here. Is this thing finally coming down, or is this just a low spike and we'll stay at a high level? Remains to be seen. Same thing here. We have a come down here. We don't know if this is just another one of these little spikes and we go back up. Same one here. But the news here at the level of customer inventories, not so good. We're still pretty low, but we're getting higher. And we're getting the manufacturers to get their businesses back and running. So overall, I would say this is kind of indeterminate. We can't quite tell ourselves, but there's good news. I would say more or less that we do have a story that the manufacturing prices are starting to come down. We're seeing early evidence in the services prices are coming down, and this may or may not be what we need to see at the higher level outside of gasoline prices for the economy's prices. But generally speaking, I would be more positive on this decline than negative, because we are seeing customer inventories finally build back to where they were. However, you can see we got to get that sideways motion out of customer inventories. We just got back to the level. We're still premature on that whole thing. So then we get into time shifts in U.S. export-import trade. So again, ISMN, non-manufacturing export, new export orders. This is the non-manufacturing. Remember, this is the services, the green line, and this is new export orders for the manufacturing. So again, this is not in the composite. This is the trade orders. So again, we're looking at all of this and we're saying to ourselves, can we learn anything? Again, this was a real shocker back here. There actually was a quick recovery of shock here. Export orders and trade, as you know, were very strong, and the ports were very strong, and goods production was very needed, and the ports really rose to the challenge for a while, but we paid off in higher prices, and you can see the import prices and export prices surge up. So when did the surge start to really pick up? You can see we broke that trend early 2021. And then again, once the vaccination rates really took up, the activity level took up again. And you can see down here, the net exports. This is imports minus exports. So the other thing to understand is we import far more than we export right now. That's the trade deficit. And that was driving the problem here, is it was the imports to the United States that drove the prices up. So was Powell late in the game here on the net export orders story? I have to say yes, because he could have seen this surge coming out of here. He could have predicted that vaccination surge there. So I would have say somewhere in early 2021, when he had vaccinations going on, that ramp was very clear. It was actually very predictable that we were going to get because it was happening by the government itself. We knew about the 2 shots and the booster shots. This is when he should have been coming into action. He came into action effectively in November of 2021. He probably should have done something with monetary policy March and April of 2021. So late would be probably 6 or 7 months late. All right, semiconductor billings, book-to-bill ratio, semi-equipment bookings. This is all at the top. I will point out the semiconductor book-to-billings ratio was canceled. It used to be over 1. You looked at strong demand. People stopped collecting these information series, so they canceled it. So all we really have here is the bookings and the billings numbers, which are far and away pretty similar. I just want to point out one thing. This is the semiconductor bookings, which are about 2 trillion here, and now they're about 4 trillion. So this is the real point here, doubling of the semiconductor overall size in 1, 2, 3, 4, 5 years. So if you want to know about the semiconductor crisis, it's a really overall demand crisis. We've had a doubling from this number to this number, and they'll track one another. These are different series, but basic point here is we can't connect to the overall series, ratios anymore, but we can look at absolute levels, and those levels have doubled. And again, down here we've got a different set of things, which is the CPIs. And again, here's the CPI transportation. These are the all-in, but this is all in, but we want the transportation index. And again, when did transportation prices on new vehicles and used vehicles, things like that, take off? And again, it's early 2021. The spot I'm circling right here, this is the inflection point. That was when the vaccinations hit. That's when Powell should have been raising rates. Now, again, he raised them here and really got into the game here. He should have been anticipating this back here. So he was basically, I would say, 8 to 9 months behind the curve. And now, of course, when you have a transportation rate, the next thing we have to talk about is whether he did catch this and whether the housing market is going to slow down the transportation market and the infotech markets. This is the other thing, is fascinating. We're slowing the housing market in anticipating of trying to drive the transportation prices down and slow the semiconductor problem down too. This is curious at the very least, because we have a housing problem. We probably will slow it down. This probably will help in the housing markets. What will it do here, folks, for the transportation businesses? Not clear it's going to be Dutch and not here. So this is another thing to understand, is Powell doesn't have control of some of these internal industry markets for semiconductors, where he's got a doubling this business over 5 years. And this transportation port situation, getting new vehicles and used vehicles and parts into the country, very big problem. So let's go to the next slide. The run in the USA and the Euro area purchasing managers, left side is Europe and the USA. The USA is pink. So I've got the USA in pink, and the other ones are the Europeans. And then the right side, I've got the flash PMI at the composite. Right over here is we've got order inventory series. So this is a sub indices. This is over the flash composite. So first, let's start over here. You can see that the flash composite for the global PMI has actually gone negative a little bit. So this is actually the first sign we have a recession. And you can see over here, it's the European orders. The USF PMI has gone down. It's right here, but it hasn't gone down any dramatic way. It's over in Europe. So this is something that actually Powell will get a lift of, because European purchasing managers, demand depression from Europe because of what's going on in Russia and the energy crisis over there has slowed their economy down. So that was something by him not slowing the US economy down. Now he got help out of the Europeans. Now I would point out to you, help from the European slowdown is probably not much of a difference for the United States. So this benefit he's getting here, probably not great. But over here, definitely more of a chance for a global recession than a US recession. So that's the next thing I would point out here. As we get into this, a much stronger case for the European economy to be in a recession, I think, than the US. And frankly, we're going to learn today, because of the shutdowns in China, we've got a real situation going on in Asia, which probably understated. All right, so shifts in the 9 global economies. This is what I'm talking about. Obviously, you know the euro parity. It's definitely a good time to be going to Europe, because the European Union has been slow in their own uptake of monetary policy, even slower than Powell. And then down here, you have the yen, which are even yet slower than Powell. Everybody, if you want to pile onto Powell, you should also pile on to Christine Lagarde in the EU and to the central bank chair in the Bank of Japan, who is super slow. But time, if you really want to go to Europe, actually it's better time, as you can see from this yen chart. It has been 25 years since you had this cheap a yen. And it's not just the yen here. This is the South Korean won, which is also a multi-decade high, lows for cheapness. So the point I point out here with the Chinese yuan, with the South Korean currency and the Japanese currency, you actually have more story here than you have actually in Europe and Great Britain. So that's telling you something else, which is there's actually more activity over here to worry about in Asia than there is in Europe, even in the face of what's going on with Russia. Interesting stuff. Let's go to the next one. So commodity price index. Top is agricultural prices, middle is food prices, bottoms is metal prices. I'm going to skip this because all this does is give us to the end of year end 2020. This is IMF stuff, so careful here. We do not have the price spike because the data does not run forward enough. Let's get on the status of the U.S. consumer worker. This is our next level of the overall demand. This is the GDP growth rate you do read. So charts for U.S. consumer confidence. Obviously, this is important. Present situation, expectations, and the total index. So these all collapsed in 2020. Obviously, we know what happened. It was the shutdown. Some of them recovered, and then they started to decline again as the pricing happened. So what really happened here is confidence kept going down after things came back during the vaccination, when people realized prices had gone up. And this is true now. So all these indices are actually lower than they've been before the pandemic. So consumer confidence is actually lower than before the pandemic, while everything else is higher. Now down here is an interesting story about disposable income per capita. You can see these spikes were caused by the paychecks. First one was right at the time of the pandemic start. And you can see there in the personal consumption spending, people stayed home, they got checks from the government. And the next thing people talk about is this spike, which is when Biden took over, he issued more checks to people. And you can see, did it really change spending? The answer is spending was on a track that was independent of this. So what this did here effectively is create savings. And you can see that this created a little spike in disposable person, but it did nothing over time. So the basic point here is Biden raised the savings rate in the United States. He did not do much to spending paths. Those were basically fixed. And as a result of the prices, getting higher and higher because of the port issues and the supply shortages across the economy, constants went down when he would have thought they would have gone up given this. So this is the story that's probably overdone. It all went into savings, but it's probably keeping the economy able to support itself longer than people think. So all this is really netting out headwinds and tailwinds. Very, very difficult stuff, people. I would not try in a short-term talk like this to tell you how these net out. It's very, very complex, and it's the netting of these events that's very difficult. All right, retail sales. Obviously, these are very strong. So the main thing you want to point out, this is the internet. They have stayed, they spiked right away at the shutdown, but they've kept going up. And really, if you look across all these things, the one thing you see here that's not doing well is the light vehicles. This is the port and shutdown issues. So you can see, even though Powell is working to restrict demand and slow down demand for housing and things interest sensitive, it really seems to have no bare relations to this problem with the light vehicle sales. This is the supply shortage in advance of anything else. This is focused on the light vehicle sales. You can see other places, though, are having similar problems. Electronics and appliance stores certainly looking like there's shortages. And furniture, not so much. So it's in the appliances and in the vehicles. And of course, that's also related to the chip problem, because these two have chips. These typically, furniture does not. So you can see this is layering in another problem, which is the chip problem. And that, again, like I said, has nothing to do with Powell. Again, would have thought, for example, one of the mistakes people made, you can see that spending on motor vehicles actually collapsed at first. So this was something that nobody would have expected that this was going to happen. This was just something that played out over time, and people began to learn about it. All right, median incomes, nominal and real. I've also got initial claims in here. This is the unemployment claims. You see, we're back down to where we used to be. Up here, we've got a nice rise in household, normal, medium, and real, and you can see now we're going back down. So actually, from a real income perspective, people are actually somewhat poorer than they were before the recession. Unemployment is pretty much reclaimed its prior level. We throw the ISM non-manufacturing employment indexes in there down here. They're just almost at 50. There's not much help from this graph, but you just want to point out basically back to a normal state of mind. Down here is employment and population ratios and a lot of other stuff for different groups, 18 and over and 25 to 54, which is more the working age populations in here. Can't actually see them because they're kind of tracking one another. So you can just basically see everybody's coming back to normal. But really, the main point here is incomes from a real perspective have not actually risen. That's getting to the consumer problem. People are finding out you just don't get that much money for your money anymore, things for your money anymore. All right, average earnings compensation. This is the wage growth story up here. You can see wage growth is picking up now. That's this line. And so it's interesting to note wage growth in this relationship and the relationship between comp and productivity down here. So you can see these tend to track one another, and they're back to tracking one another, but the compensation is trying to catch up to those prices. So this is all about that pricing. And again, you could say, when did this start to happen? When did Powell see this series happening? This time it's early 2022. So this is lagging by a year, this chart. Okay, so that gets us to the final thing I'm going to talk about is total factor productivity gains. This is a subject that economists use a lot, and I'm going to talk about it in terms of economics. Total factor productivity, TFP, also called multi-factor productivity, is usually measured as the ratio of aggregate output, which is GDP, to aggregate inputs, which is capital, labor, and something else. Under some simplifying assumptions about production technology, how you put capital and labor together, growth in total factor productivity becomes a portion of growth in output, GDP, not explained by growth in input and capital. So this is the third thing. How do we put together the factors of productivity? All I want to point out here We can get into total factor productivity, capital productivity, inputs, all these different things. The main point here is they get very spiky on these periods of time when you enter a recession. There's some volatility that's introduced here. You can particularly see this in the productivity intensities out of the 08 period. Surprisingly, because you draw down labor and capital in use, you get a total productivity gain. It's just how the ratios work. You can see the same thing here. What I want to point out is after these things spike or decline, you have these periods of recovery. This is what happened in 08 and 09, and you can see the shutdown. It basically looks fairly similar. The point here is now we've got another issue, which is just the volatility of the entire situation playing itself out and having to have time pass to get the volatility to quiet itself. You're going to really see it here in the real value added output power. You can see that spikiness. Output per worker, you can see that spikiness. So people, yeah, they're getting a productivity gain measured in the macro variables, but they also did so out of the prior recession in 08. This is standard stuff. So this is just a volatility metric, not really giving us a great read on the economy. So I hope you enjoyed this today. Again, you need to get the slides to go through all the material in detail and really study this. Thank you for attending. I do these every couple of weeks. And if you want to get a hold of these slides, you can call us at 866-794-6065. Email us at strategycall@zackpro.com or go to our websites, www.zackspro.com. We also have an in LinkedIn at Zacks Professional Services, and we are on Twitter at ZAT Tools. So just one more time before I go, 866-794-6065, and it's strategycall@zackspro.com. Thanks for your time.